Well, I mean, obviously, what you're referring to with the warmer months is driving season in the US with very low unemployment. So we're going to see, as we always do, two things. Firstly, you get more demand during the summer, but before summer, the refiners need to switch to make summer-grade gasoline, which tends to tighten the market. But they're actually struggling to make diesel because we're most short of all distillate, which is diesel effectively, and therefore we may have a gasoline shortage this summer. We're talking about $110 to $140 Brent over the course of this year. So at 120 today, we're kind of in line with where we thought we would be given the disaster in Ukraine.
Does the U.S. have natural gas to supply to Europe right now? And what does that do to the pricing dynamic for nat gas?
You know, the biggest problem with natural gas in the U.S. isn't the geology, it's the pipelines. You know, and what they've got to do is much more to facilitate pipelines. Natural gas is responsible for the lowering of U.S. carbon dioxide emissions over the past 20 years as it replaced coal in the balance. So I'm very against lumping natural gas in with coal and calling it fossil fuels. It doesn't make any sense. And of course, we've seen in Europe with very aggressive carbon dioxide reduction emissions targets, they ended up hugely dependent on natural gas, and that's become obviously a huge problem for them. But it's, as you imply, it's very good news for US E&P companies. And right here we have the Marcellus, which we call the Saudi Arabia of natural gas. So the potential is very much for us to export a lot more natural gas, and it's very good news for the United States of America.
So who stands to benefit company-wise and producer-wise?
Well, ripping today, EQT is pretty much the biggest U.S. gas producer. Tellurian is an LNG export play that isn't up and running yet, but is a development company. And the classic is always Cheniere, which is the existing major LNG exporter in the U.S. A couple of others that have been beaten up are Shell and Total, major exporters of LNG from the U.S. So there's a number of ways, but not that many. And we think Shell should break up and actually make a standalone LNG company to take advantage of what's going to be a huge future for LNG. Just one add on LNG, demand didn't fall during COVID, to give you an idea of the structural secular bull case for that particular energy theme.
Yeah, it's a key point, and we talk about it, I mean, as perhaps as it rightly should be, as a bridge fuel, but also when you talk about adoption of hydrogen technologies, natural gas and LNG plays a role potentially in that process as well. You just mentioned the possibility of shortages of gasoline and fuel shortages this summer. I mean, how real is that? How do we avoid that?
Well, we're just very concerned about inventory levels. And, you know, what we've had this week, which caused oil to go up a lot yesterday, were two things. Firstly, Putin saying that he wants to be paid in rubles, which obviously is having everyone scratch their head, but also simultaneously reminding everyone what a disaster this dependence on Putin is. That was the first thing. And then secondly, the Russians announced they would block off Kazakh oil exports, which is, you know, 1 million barrels a day of additional lost exports of oil that's not actually sanctioned but has to travel through Russia. So just those things alone are kind of scaring the market, and we're pricing the potential for really major problems, particularly as regards that ruble payment thing, which basically Europe can't substitute the amount of Russian gas they use anytime soon. It's just not physically possible, particularly for Germany. So there's a real problem here, and you know, the market's pricing, as you know, European gas accordingly, essentially trying to destroy as much demand as it possibly can, unfortunately. So effectively, there already is a shortage.
Paul Sankey, thank you for your insights.
Thank you.